Welcome back, wealth builders, entrepreneurs. Michael Rosmer here with Richucation. Excited to be with you guys. Thank you for being here. I hope you're getting lots of value out of the videos. We're going to talk today about the subject of due diligence. And this is not going to be an exhaustive lesson into due diligence because due diligence can be a huge deal. And part of the key to really great due diligence is understanding what it is you're investing in or buying, etc. Okay? So if you don't have background knowledge, if you don't understand what you're investing in, if you don't understand the market for what you're investing in, then or buying, depending on how we want to look at it, then you're in a position where you're not going to be able to do effective due diligence. Okay? So if you are getting into it and you don't know those things, part of your due diligence will be to learn those things. All right? Rule number one of investing is only invest in things you understand. All right? Now, due diligence. So this is going to be some best practices, things that I have learned over the years that could save you millions. All right? Lots of cases, people have lost millions because of not following these. All right? So the first thing that we're going to talk about is doing deals with bad people. All right? Doing deals with bad people. And what do I mean by bad people? I mean unethical people, immoral people, unscrupulous people. Okay? Warren Buffett says you can't do a good deal with a bad person. That might be a little bit extreme. There is, and we're going to talk later about structuring, and so there are definitely some things that you can do structurally to help protect against it. But as a general rule, if you discover somebody is a shyster, walk away. It's just a best practice. And I'll tell you a specific story about a transaction that a friend was involved in where this happened to be the case. And we'll talk a little bit about some of the due diligence that he did that was good, but also some due diligence that he didn't do that if he had done it would have helped. And that's going to be one of our great points, which is awesome. Okay. So what happened was he was buying a company. There was two owners of the company, these two brothers. They claimed the company was doing annual profit, if I recall, $200,000 a year. Okay, it was a pretty staple company. It was the type of business that this friend of mine wanted to get into, and they were asking $600,000 for the company. Okay, well, when he ended up, so, they did all kinds of due diligence, etc. They went out, they looked at the place, they talked to the bookkeeper, they, did all kinds of different things. They wrote down serial numbers of equipment and looked it up, and he flew his bookkeeper in to go take a look, and all this kind of stuff, right? You'd think, like, great. Well, in the process of their due diligence, some of what they discovered was they had a huge list of creditors who were after them, okay? Like, they had burned seemingly a lot of people, okay? This should have been a red flag, should have been a warning sign. And he and I have talked extensively since this deal, because what ended up happening was he ended up buying it, and when he took it over, he discovered it was not at all what it seemed like. What turned out was that the company was actually losing money. So every piece of equipment on the property broke down within the first week. You can imagine how bad that is. And the property and the company was not making $200,000 a year. They had taken it down. They had figured out that it wasn't making that much during their due diligence, but they weren't sure quite how much. They looked at the financials for the company, etc. And it turned out the company was losing money. So it cost him, directly. So he had ended up negotiating the price down to $500,000, I believe, and it might have been that it was $400,000 with another $100,000 paid later. So he did get it for a lower amount of money. And part of the thing was he told them, like, I can't pay you more because I don't know. And the lawyers, because it was so, like, the transaction was, like, utterly fraudulent, the lawyers said, hey, you could easily sue them for this, but they have no assets. So you can't get anything from them anyway. There's this huge list of creditors. There was like 70 creditors or something like that. Like, get in line, okay? So he didn't end up having to pay out that extra $100,000 that was with the attorney, but there was still this, massive problem, okay? So it cost him an additional, I can't remember, $100,000 or $200,000 to get the business kind of to a break-even point, right? Worked, but it also took massive amounts of energy away from his existing business. His existing business was paying him about $500,000 a year or something. So all in all, in opportunity cost, this business cost him over $1 million in addition to the purchase price. Okay? Very painful, very costly for him. So this is an example of doing a deal with a bad person. Now, what went on? Well, they blatantly lied about a lot of different things that were going on. Okay? For example, they'd transferred staff from the books of this company to the books of another company in order to not show that expense. The bookkeeper was complicit and fraudulently provided them with documents. The financials that they were provided with were fake. They'd been faked. They were not actually come from this accounting firm. Okay, so it was a well-known accounting firm in the city where this friend of mine lived. He knew about that firm. He just assumed they were good. Turned out they weren't. Okay? When you get into a situation where there's somebody who they're a shyster to deal with, just walk away. It's not worth it. Okay? Again, there are some cases where there's very clear ways, like institutions can do business with those types of people. Okay? So as an example, like a major bank. The major bank just has very clear criteria that you check their boxes. Their boxes are designed to protect them. If you can't check those boxes, you won't get the loan, etc. Okay? I have a former business partner and friend who I mentioned. He unfortunately is not somebody who plays win-win with the people he does business with. And so I mentioned that, he does well with the innocents and the institutions. Because the innocents he can exploit, and the institutions just, they have their criteria, and he just pays the market rate for that, and that's fine because the market rate is low enough. People in between, sophisticated investors, can't do business with him. And it becomes a challenge for him to do, but he can't scale his operation past a certain point, which is a consistent, he's done numerous businesses and always had this problem. Okay, so doing deals with bad people, don't do them, okay? Character matters when you're doing business, all right? So that's lesson number one. And by the way, you don't want to invest with those people, you don't want to whatever, okay? And you might think like, hey, all is well, etc. There are some structural things, as I mentioned, that you can do to protect yourself. And I've helped various people protect themselves in those situations, which is great. Praise God, whatever, that, they were able to get their money out because of these structural cases. But even protecting their money, they would have been better off not having gone into that deal. Okay? So don't do deal with. Now, there's a difference between somebody who, hey, they're a shark, and somebody who's a bad person. Okay, like some people are looking for a deal, and they're going to grind you, and you can do business with those people. Okay, they're tough to do business with if you're looking for a good deal and they're looking for a good deal, but you can do that. That's different than being like flagrantly immoral and not caring about the person on the other side of the table. Okay, so with that in mind, we have our next lesson, which is okay. In the case of my friend, you can kind of notice that aside from walking away, and he mentioned this was one of his lessons, he said, on reflection, when he saw all this stuff about all these people after them, he should have walked away. Right there, cut the deal off, gone. Okay? That being said, go to the source. Okay? This is probably one of the biggest pieces of advice I can give you around due diligence. It will by far save you so much. So as an example, in the case of that accounting firm, if you're going to spend $500,000, $1 million, $5 million, large amounts of money, go to the accounting firm and verify those financials. Like, don't take the person's word for it. Whatever the person, if somebody is selling you something, basically you have to assume that you can't trust anything they say. That's pretty harsh, right? It's unfortunate, but it's just, if you care about doing good due diligence, you need to verify it yourself. If they say, hey, here's the market demand in this area, verify it. Okay? Generally, if the deal is too small, it's like, hey, I'm investing $5,000, it's not worth it to do that due diligence. Probably it's not worth it to invest at all then. Okay? You're better off just sitting it somewhere safe and wait till you have more money. If you're in a deal that you're going to have to go through due diligence, go to the source. Okay? Go to the source means, hey, check all the facts and assumptions, right? So in the case of this friend of mine, like I said, could have gone to the lawyers, to the accountants, and said, hey, I got these financials, etc. from them, what can you tell me, etc. Now, obviously, there's a certain confidentiality going on in there, right? But he could have found out that, hey, look, they aren't even a client of ours. We haven't prepared those financials. We'd be like, whoa, all right, walk away from that deal, right? If they're lying about that, what else are they lying about? They can't be trusted, right? Now, there may be times where all the information, the person is highly diligent, highly integral, etc. I have a really good friend, one of the people I most respect, and he is like that. Like, if he takes you a deal and he gives you facts and assumptions, etc., he'll go through everything with you. It's well validated. You can double check it. He's super high integrity. I would give him $1 million without any security and be very confident that I would get it back, because that's the type of person he was. I wouldn't recommend doing that. Don't. But the whole point is, that's the type of person he is, right? And there are occasionally people like that, which is great. But most of the time you don't know, and most of the time, even if you do know, there's this expression, we talked about it in the section on management, trust but verify, right? Very, very important, trust but verify. So go directly to the source. Go and get if they say, hey, there's a mortgage for $1 million on this property, get a copy of the mortgage. If they say, hey, the property is worth X amount of dollars, get a copy of the appraisal. Ideally, have your own appraisal done, because appraisals are pretty all over the place. I've seen cases where they show a lot of transparency. They're like, here's the appraisals, here's this, and it's like, there's a little bit of a disconnect in the story that you're telling here if we actually dig into where that appraisal is coming from, what the assumptions are behind the appraisal, etc. I'll give you a great example of this, actually. So, there's a client we were working with. They wanted to invest some money in a Latin American company, or country, okay? And it turned out we knew the people who they were wanting to lend the money to, okay? So we got on the phone, and it was supposed to be, we said, okay, well, what's the security? I said, it's these, we're going to give you 2 properties. It was a real estate development project. I said, okay, great. So what's the value on those properties? He said, it's, X amount. Huge multiple, much higher than the amount of money being lent. Like, okay, great. Well, fantastic. Just send us over the comparables and the assessments, and, shouldn't be a problem then. All of a sudden they're like, whoa, well, it's very difficult to get comparables for a property like this, and da-da-da. And so when we ended up doing our own due diligence, it turned out that the value of those 2 properties was about 1/5 of what the money being lent was. So obviously we told them not to do that deal. The whole point is, somebody will throw around all this kind of thing. That what they were using as comparables, it was like they were comparing oceanfront property to property in the middle of the jungle, miles away. And it just wasn't a fair comparison, right? So go to the source, all right? Next thing to understand here. Is understand the numbers. Understand the numbers. I'll give you 2 examples of this. One, we can go back to my friend. So, as an example, with respect to the staff. See, so they were able to offload the staff to the other company because my friend didn't understand the numbers. All right? If he had understood the numbers, if he understood, hey, look, here is what's required to run this operation to make this work. I mean, 2 things could happen. They could have audited, gone and counted the staff and looked at, is there a match? The other thing is just, hey, look, the amount of payroll that you have listed here could not run this operation. It just won't work. So there's something wrong here, okay? This is, Warren Buffett talks about this with respect to taxes, right? He says, like, look, if I don't see a company's paying enough tax, then I know there's something up, all right? If you're going to cheat on your taxes, you're probably going to cheat somewhere else, okay? So those numbers have to make sense. I'll give you another example. There was a deal that I almost did. I think I mentioned this somewhere else, where someone came and they were refinancing an apartment building, okay? So they owned an apartment building. It was, I think, around $3 million, but I can't recall exactly. And in order to get this financing, though, there was a gap, and so they needed some bridge money to close that gap in order to be able to qualify for this financing, okay? And so they came and they said, hey, we need, I think it was $300,000, okay? And said, okay, great, here is the terms, you know. And I think what we said was, okay, it's going to be 1% a month for the money, and if you default, it's going up to 2% a month, and da-da-da-da, right? They said, well, that's pretty expensive. Well, let me see if I can, I think I can do better. I think I can get cheaper money, but if I can't, I'll come back to you and I'll do this deal. Now, that would have been a mistake. In the meantime, I ran the numbers on these properties, and what I discovered was it was impossible for them to pay that interest rate on this money. The amount of cash flow that they were going to get from the property was insufficient to pay for that loan. So the only way they could have done it was if the property appreciated massively in a fairly short period of time, which it wasn't going to do. And so, as a result, if that money had gotten lent, it would have probably resulted in a loss. It would have defaulted. Now, the whole point here is to understand that people will promise you something they cannot deliver. Okay? This will happen. I've had people sometimes where they come for a private loan and they say, hey, look, you know, I need to borrow some money. Can you help me out? And I've done this enough times and lost money on a bunch of these cases to know that I'm leery of it, and usually I'm doing it for a friend now, where when I'm doing it with the friend, I'm saying, okay, I expect to lose the money, and if I get it back, great. If not, whatever, right? But somebody will come to me, and I had this one point in time where someone came, and I said, okay, well, how are you going to pay me back? Which is always the question, right? Where is the money going to come from for you to repay us? They said, oh, well, you know, I'll pay you from my job. Okay, that's percent of job, great. I said, okay, well, what are you going to pay me? They said, well, I'll pay you 50% of everything that I make. And, you know, so they'll promise this because they're desperate, right? They need this money, or they want this money. In this particular case, it was, they didn't need it, but they would suffer if they didn't get it. There was an emotional cost to not getting it, basically. So what I told them was, I'm like, well, let's look at your expenses. Because what I know is that you cannot afford to pay me 50%. It's just not, you will not be able to afford to pay your bills if you're paying me 50%. And as a result, you're going to default on that. So it's unreasonable to expect. So we negotiated a much lower percentage, and, you know, I figured, okay, you know, maybe there will be payback, maybe there won't be, you know, it's fine. If it is a loss, it's, you know, something I did to help a friend out. So anyway, that's an example of where you like go to the numbers and say, do the numbers work, right? When I was mentioning earlier the story of these mortgage investment companies, I remember, you know, when I was just first getting started in investing, I would look at, hey, what's the rate of return? That would be like my big question. What's the rate of return? Now it's like the last thing that I ask. Because the problem is, most of the time those numbers can't be relied on anyway. So unless I've validated their assumptions and I can see that the underlying economics are going to work, it doesn't matter. You know, they can, and I saw lots of cases of this where somebody would say, oh, we're going to pay you 10% a year, we're going to pay you 12% a year, we're going to whatever, and then there'd be a loss for the investors. Not always 100% loss, right? Private mortgage deals where it's a 30% loss, or, you know, stuff like that. Bottom line is, there's a loss. And what's going to happen? So the way to protect yourself against that is to understand the numbers, go to the source, and don't do deals with bad people. Okay, so those are our pieces of advice. We'll jump into structuring how to protect yourself in the next video. In the meantime, if you want some support and assistance on this, maybe you're doing a deal, maybe you're looking at lending some money, maybe you're looking at buying a company, etc., reach out to us, join the action classes. If you want to take your company to the next level, join the action classes. I'll see you on the next video.